Hi, everyone. Good afternoon. Thank you so much for joining us for today's free webinar, Debt Funding Options for Growing Companies, with Molly Otter from Lighter Capital and David Ehrenberg from Early Growth Financial Services. My name is Erica Malsberg, and I'm the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. This presentation is going to run about 40 minutes or so. If you have questions as we go along, please feel free to just jump right in with them. Don't just raise your hand. Just enter them into the text field and ask them as the questions pop into your mind. You can also tweet them to us at Early Growth FS with the hashtag debt funding. We're going to try and take questions as they come as we're going through the presentation, or we may wait until the end of the webinar for a brief Q&A at the end to answer any remaining questions. You'll also get our contact information at the end, so if you have any outstanding questions, you can follow up with us after the presentation. And we'll be sending out a follow-up email to all of you tomorrow that will have a link to the deck as well as the recording, so you'll have that for your reference. Before we get started today, I just wanted to briefly introduce our presenters. First, we have with us Molly Otter. Molly joined Lighter Capital in 2013 as Chief Investment Officer and VP of Credit. She has over 11 years of experience as a debt specialist across all segments of the capital structure. Molly was previously a vice president at AEA Investors LP. Molly joined AEA as part of the initial founding of the debt group in 2005. During her tenure at AEA, she served as member of both the mezzanine and senior debt teams and was involved in over 25 portfolio investments. She has previously worked at American Capital Strategies, a business development corporation, and GSC Partners, a private equity firm with investment vehicles which serve the high yield and distressed debt industries. Molly received her MSc from the London School of Economics and a BA in history with a minor in economics from Dartmouth College. So hello and welcome to you, Molly.
Hi, Erica. Thank you.
Sure. And we'd also like to introduce David Ehrenberg. David is the founder and CEO of Early Growth Financial Services. As CEO, David has overseen incredible growth at Early Growth, leading to its being ranked number 13 in Silicon Valley Business Journal's Fast Private for 2014, and also made the list for the INC Inc. 5000 for 2014. David's an active speaker within the startup ecosystem, and his insights have been published in Forbes, Inc., VentureBeat, and more. In short, David's a financial expert and startup mentor with a passion for supporting founders and helping businesses to focus on what they do best. So hello and good afternoon to you, David.
Thank you very much.
Sure. So Molly, can you take a few minutes to start by just saying a few words about Lighter Capital?
Of course. Thank you all for joining us. I'm excited to be talking about debt, as it's one of the things that I've specialized in over my career. Lighter Capital has a unique take on debt. We fund early growth starting businesses with $50,000 to $1 million in growth capital. It's a debt instrument that is between kind of a senior debt and equity-like, in that we think it's really entrepreneur aligned and is very friendly in terms of growing your business. It's meant to be growth capital.
Great, thanks so much. And David, how about just a few words about Early Growth Financial Services?
First of all, let me say I'm incredibly excited to be on this call. Lighter Capital has been an incredible partner for Early Growth, and so we're excited to do this webinar with Lighter Capital. I think that they have a wonderful product and offering that is a perfect fit for a lot of our clients, but it's an area that a lot of our clients don't know about. So I'm excited to be doing this with Lighter Capital, and I'm excited that so many of you have joined our call. I think that's fantastic. Erica talked a little bit about Early Growth. We've been around for just about 6 years, but during that period of time, we've had really rapid growth. And we support about 500 early stage technology companies across the country. We have offices in the Silicon Valley, San Francisco, LA, Las Vegas, Seattle, Boulder, Austin, Chicago, and New York. So we have people in 9 different locations across the country, and we support about 15% of the venture-backed companies, private venture-backed companies in the United States. So we have a pretty strong concentration in the technology area and the technology space. We provide 4 key different services. We have CFO consulting, and we have about 30 CFOs. And they do the exact same thing a CFO would do at a larger company, just on an outsourced basis. We do transactional accounting. We have about 85 accountants, senior accountants, and controllers, And they're doing the day-to-day accounting for all of our clients. They're doing accounts payable, they're doing payroll, they're doing a formal monthly close, they're taking care of the general ledger transactions, and they're creating financial statements. We also have a very large tax practice where we're doing state and federal taxes, sales and use taxes, R&D tax credits, and we have a valuation practice. And although we do some high-end valuations, really the bread and butter of our valuation practice is 409A valuations, which are the valuations that you need if you're a private company and you're giving out stock options. But those are the 4 key services that we have. And like I said before, we really have a strong focus and emphasis on early stage technology companies. I think that's it, Erica.
Awesome. Thanks. So I'm going to basically hand it off to you, Molly, to just go ahead and dive right in.
Terrific. Well, thank you, David, for that great introduction to early growth and for a little bit of background on how we worked together with Lighter in the past. Today's webinar is going to be focused on debt funding options. It's not always the first things that entrepreneurs think about when they're starting their business, but it can be an important part of growing your business over the long haul, and especially if you want to continue to maintain ownership of it. So today's agenda starts out with debt funding. We're going to walk through kind of the capital stack and what you should think about in terms of what the different options are that are out there. Then we're going to move into all the options that are available. So what they are, when to use them, how to think about them, costs, etc. And then we'll finish off by talking a little bit about how to decide what the options are for you and kind of how to prepare to go for whichever option you think is the right option and as we move forward. It says at the bottom that we'll take questions and answers at the end. As Erica mentioned, if you have any questions throughout this presentation, please feel free to write them in, and Erica will pop in with them as we go, as it's always helpful to get questions when we're on the slide that we can point to. But we're also happy to take some at the end. So the first part that we want to talk about is a little bit about the capital stack. So when you think about your business overall and your company, it kind of ranges from equity at the top to investment grade debt at the bottom. And when we talk about the capital stock, we're talking a little bit about the cost of capital and the requirements that come with it. So if we work from the top down, I think everybody's kind of familiar with common equity, which is generally just common shares in your business. It's the equity that you own in it. It's sometimes considered the most expensive in terms of what the cost to you if you own your business might be. But obviously, if you're the founder of your business, it's what you own. You own the equity in your business. From there, we can work our way down to preferred equity, and that is generally what venture capitalists and angels put into the business. They put in a combination of between preferred and mezzanine on some level when they do convertible notes. But preferred equity generally comes with some type of coupon. So there's some type of payment that they're expecting on the base amount of money that they put into the business. Now, they're not expecting it to be cash pay, as in paid out on a monthly or quarterly basis, but they do expect it to get paid out first before you pay out the common. So when you look at the capital stack, you can kind of start at the bottom and determine who's going to get paid first and who's going to get paid last in any type of liquidity event. So from a debt perspective, you kind of, after you've got the two types of equity that are in there, common and preferred, there are a number of different forms that the debt can have in your capital stack. The most senior amount, the blue here on this graph, is the investment grade debt. And that's the type of debt that your bank is going to provide you. Sometimes it comes with a personal guarantee, sometimes it's just the business, but in most cases, somebody is guaranteeing it and there is a lien placed on some asset in order for it to be issued. And it's generally issued by your traditional bank or a local commercial bank. They're the ones who are doing the investment grade debt. Up from that is kind of the junior or unsecured debt. In this case, revenue loans, which Lighter Capital provides, would fall in here. We're junior debt. We do take a lien, but we do come behind a senior position. You've got unsecured debt. Those are the people who don't take a lien, but in the structure of things would come before an equity payment. And then you would have on top of that kind of the tech and venture debt. And then from an expense perspective, that would be in the same order. So kind of the tech and venture debt would be the most expensive, and then you'd move down into kind of revenue financing and then traditional debt, obviously being the cheapest debt that you can find out there.
So I would say that the big thing for all of you to think about here is when you're thinking about financing your company, just understand the very, very high costs of equity. So especially in your early days of your company, when you're just starting out, when you're just beginning to have revenue, typically equity is incredibly expensive. And it's not, the cost that you're giving up is ownership in the company. And a lot of times I find that entrepreneurs don't think enough about that equation. They know they need money, they know they need growth capital, and it's essential that they get that money in order to build their business. And they often just think about equity. But that equity comes at a huge price. And if you can secure debt at an early stage, it's always advantageous to do it. Even if it's an expensive debt, it's still significantly cheaper than getting equity. So
Right.
those are things to just keep in mind. Sorry, Molly, I didn't mean to.
Yeah, I was going to actually add on to that point. I mean, when you think about debt, you know exactly the cost of your debt in your structure. At Lighter Capital, we're completely upfront about how expensive that loan is going to be for you. The same thing is going to be about any type of debt that's out there. Even if you think about getting the mortgage for your house, when you signed the mortgage paperwork, they told you exactly how much you were going to pay over the life of the loan. Whereas equity doesn't really tell you that. They say, we're taking this chunk of money in your business, a percentage that we're going to own. And so there's no cap on how much they're going to get out of that for the amount of capital that they put in it, right? They're going to get whatever percentage they own of it when you sell your business. Whereas debt, it's very clear exactly how much you're going to pay. Now, it may seem expensive because they're telling you how much it is up front, but at least you know the overall cost to you as the business owner as you look at kind of funding your business as you go forward.
So we have a question here from.
Okay, maybe
Yep, we have a question here from Linda real quick. She just wants to know if you can just briefly explain the difference between unsecured debt versus secure debt.
Sure. So unsecured debt means that there is no lien on your business or from you personally, whereas secured debt requires a lien on your business, and generally that's done through what's called a UCC filing, which is a filing with the Universal Commercial Code, and it signals to anybody out there that this person has the first right, and usually the way the UCC filings work are the first person in line to receive money out of your business if your business were to go into bankruptcy. And so that's the difference between the two. Another form of secured debt could be a personal guarantee. So you, as the individual business owner, are required to provide a personal guarantee for a significant amount with traditional bank loans, especially smaller ones. SBA bank loans don't require personal guarantees a lot of the times, depending on the size of them, but your traditional bank may require you to do a personal guarantee, especially around a line of credit. Your credit card, for instance, is personally guaranteed. You're the one who has to pay that back. You personally guaranteed it. And MCAs, so merchant cash advances, pretty much all of them have a personal guarantee component to them.
Great, thank you.
So David and I had just touched on this a little bit before, but the cost of capital and kind of where it falls in the structure of when you should get it. So at the bottom of this chart are where your business is. Is it in the idea phase, the launch and traction, growth, breakout, and established? And we kind of consider here in this chart breakout and established to be revenue of more than $5 million. And then the kind of going up is the amount that you can expect to receive. So 50,000, $500,000, and $1 million across the board. So there are all sorts of different types of financing sources out there, especially on the debt side, that you can think about for different stages that you are in your business. So at the idea stage, there aren't really a lot of options for you to go get debt, because most debt requires that you have some type of revenue coming into your business in order to fund it. And a lot of debt requires that you have some type of positive net income in your business to fund it. So at the idea stage, you can think about going and getting a credit card line. As I mentioned earlier, that's going to be personally guaranteed. You personally are going to have to pay that back. There's peer-to-peer funding, or maybe crowdsourcing at that stage might be an option for you. But then as you start to gain traction and you've launched your business and you're still less than $5 million, but you have a revenue source, there are a number of options that could be out there for you. Lines of credit, from your bank, I always recommend that your first stop should be your bank. It's going to take you a long time to get a line of credit from your bank or any type of loan from them, but you should start the process early because it's going to take a while, but the cost of capital is going to be the cheapest. Kind of the line of credit there. Now, they may require a personal guarantee, and that may not be something that you want to do, but that's definitely going to be the place that you should at least get in the door, get to know your local bank, not kind of the big bank that you think is like where you want to end up banking, the Silicon Valley banks of the world, because those guys really aren't going to help you out until you get more than $5 million in revenue. But if you're just a small starting out, go to your local guy. They're the ones who are going to be the most helpful for that type of stuff.
Molly, can I just jump in at that point? There's a lot of great regional banks that are located around the country that really specialize in early stage companies. And if you're looking for a bank like that, if you're with, say, a big B of A or a Wells Fargo and they're not paying you much attention, shoot us a line, send us an email, and we can give you introductions to some banks that really specialize in smaller firms. And if you don't have a banker that's a good fit at this stage, you really should get one.
Yeah, same thing for Lighter Capital. If you have a question about a bank or you're looking for an intro, send us an email too. We're happy to help out. Early Growth certainly all over the country. Lighter Capital, we're based here in Seattle, so we're a little bit more regionally. But we do loans across the country, but our banking relationships are a little bit more regional here in Seattle. But it's always great to get to know your local banker because as you get bigger, the SBA loan is a great place to go. If you have net income, if your net income positive is a requirement of the SBA loans, so that's just something to keep in mind. We've got on here merchant cash advance. It's something that I would caution everybody about. They are quick, they are fast lines, but they are not growth capital. They are, if you're in a pinch and you need you need to make payroll that month, and you have a big AR out there or a big win out there that you think you're going to be able to collect on that you can pay it off with, and probably go ahead and do the merchant cash advance, but please, you do the math first. We have a great calculator on our website that shows you how expensive your line is going to be, and you should really think about it because daily and weekly ACHs add up to fairly high interest rates, so just something to be aware of out there. I'm obviously going to put a little plug in here for Lighter on the revenue financing side of this. We think we're a great spot for you if you're over $15,000 in monthly revenue. We don't need you to be net income positive, so you can be losing money for our loan, and we take a percentage of revenue. So if you're trying to match up your cash ins and outs, taking a percent of your revenue is a great way to do that versus having a static payment that you have to make every month, which is what you're going to see with most of these loans that are out there. So we think it's a great option for growing companies, and we like our capital to go towards growth versus just towards, as I was discussing with the NCA, having to make payroll next month. That's not a great use for our capital. Our capital is great if you want to hire that next sales guy to take you to the next level. So when you're in this early stage, and David, correct me if you feel differently, but the capital is fairly expensive if you're below $5 million in revenue on a yearly basis. The convertible debt that's on here is definitely expensive. They're going to have basic requirements, minimums that they're going to want to get back their money on, so something to keep out there. Once you get over, go ahead.
So I agree with you completely on the $5 million and under. We should talk a little bit about convertible debt, because although convertible debt has debt in the title, it's not really debt. Convertible debt is money that you raise from an outside investor that will convert into equity as soon as you reach your next round of financing. So although this has convertible debt on it, the best way to think about it is as equity. So it has the same concerns around it, around dilution and ownership that we've been discussing throughout this presentation.
Yes. But from a lender's perspective, convertible debt on your cap table looks like debt because it has a maturity date on it. So it has the downside of converting into, or downside from you as a founder is converting into equity and causing the dilution issues. It also has the downside from a lender's perspective as having a maturity date, which may be fairly recent or fairly soon because they're generally a year to 18 months out there. And that can make other lenders, like an SBA lender, fairly nervous because they see this huge payment that's due in kind of 12 months from now. So just something to be aware of, that the other factor, because it does have that debt on there, it has a maturity date and it technically can be paid off in a period of time.
Molly, can we pause for a second there? Erica, are there any questions on that concept? Because I think, especially with our client base, this is a fairly important issue.
Yeah, we don't have any specific questions, but I'm sure the audience would appreciate if you would sort of elaborate on that point and explain a little more.
No, I think, we're just seeing convertible debt coming out more and more often, but I don't think everyone understands the ramifications of convertible debt. I mean, there is that huge dilution that's going to come around when the next equity round is going to be raised. And also there is the fact that other lenders out in the marketplace are going to see it as debt on your balance sheet, as Molly mentioned. So those are two big drawbacks, and just make sure that you go in with your eyes wide open if you're looking at convertible debt. I also know that we've written a couple different blogs and done some presentations just on convertible debt. So if you are curious about this topic or you want more information, there's quite a bit on our website.
Yeah, it's definitely something for everybody to be aware of because it's certainly a popular instrument these days.
Absolutely. Absolutely. Okay, I didn't mean to. I'll stop cutting you off, Molly. Sorry.
No, very helpful. I appreciate it. I was just going to spend a quick moment on the options that are over $5 million in revenue. So AR factoring, this doesn't really apply to a lot of early technology companies because there isn't a lot of AR, especially in this world of SaaS. One of the big benefits of SaaS businesses, as I think everybody's aware, is that you can get those annual payments up front, and so it can almost help you fund your business from a beginning, from an early stage. But if you do have AR out there, AR factoring is a cheaper way to go about getting additional financing, certainly cheaper than merchant cash advance, although similar to merchant cash advance, it's not a great way to grow your business. It's a great way to pull forward some payments that you might be expecting, and it can be fairly reasonably priced, but it's not a great way to grow your business. But once you get over that $5 million in revenue hurdle, there are a lot of people who are interested in talking to you, the SVBs, the Square Ones of the world, because you've got enough revenue, and they offer some more traditional loan products, lines of credit, term loans being you get a certain amount of money, it gets paid back every single month over the life of it. Sometimes they're fully amortizing, which means that you pay off the entire loan over that monthly period, and sometimes they come with what's called a bullet, which means that you pay off the entire, you just pay off interest and then you pay off the entire amount at the end of the loan, or you may do some portion or combination thereof. And then the newest thing that's out there are MRR lines, which are monthly recurring lines of credit. They're lines of credit based on your if you're a SaaS business, the annual recurring revenue that you're seeing. And those can be also great sources of just running your day-to-day business, working capital management, etc. And then up in the top corner here, we have venture debt. Everybody talks about venture debt. Venture debt is a little bit hard to find, and as it states as the first word in it, you kind of have to have a venture capitalist already in your cap structure in order for them to come in. So they do come in earlier, kind of in the launch growth stage, so they can come in earlier, but you have to have one of the top kind of 10 Silicon Valley Bank, Sand Hill Road venture capital players in there for them to really participate. So they're not necessarily somebody who's out there for everybody. And they are super expensive and tend to take a fair amount of warrants on your cap table.
Yeah, and just to talk a little bit about venture debt. So the way that venture debt typically works is that you have a loan from either a venture debt firm or a technology bank that's specializing in venture debt, and that loan will look like a normal loan in that it will have a repayment time period and it will have an interest associated with it. But in addition to having the repayment and the interest, the bank or the venture debt firm will typically take warrants as well, which are options for ownership in your company. And the big thing about venture debt, everyone always thinks about venture debt. And if you are raising an equity round, it's worth thinking about a venture debt round. but it's very, very difficult to obtain venture debt. And in almost every situation, the decision to provide venture debt is decided upon not your business or your revenue stream or your executive team, but it's decided upon based on who your venture capital partners are. So if you're with a top 10 or a top 20 VC firm, the Kleiner Perkins or the Sequoias of the world, this is very much an option for you. But unless you're with one of those top tier firms, it's probably not even worth thinking about.
Yeah.
Sorry, just wanted to, my 2 cents on venture debt.
Yeah, no, I think that's very true. I think on the next page, Erica, we kind of go through a comparison of where everybody is. So maybe we should flip to that so we can kind of.
Sure. Yeah. Before we flip, we have a question here from David. He wanted you to speak a little bit to the traditional commercial loan option, and he was specifically asking, how large do you see traditional commercial loans get for established companies? I mean, I would assume that's hugely variable, but do you have a ballpark for him?
Yeah, so traditional commercial loans can go up to, well, depending on how big your business is. So if your business, they go up to about 3 times EBITDA. And so that's just across the entire spectrum. So it's even talking about traditional commercial loans that you might see out there that are traded on Wall Street. The max that you'll see is about 2.5 to 3 times your EBITDA. EBITDA being earning before interest, tax, depreciation, and amortization. It's not a term that most early stage companies use. This is much bigger, so just that spreads the whole spectrum of what's out there. But traditional commercial loans are structured as generally with financial covenants that are structured around your earnings. So they're looking at your net income and they're determining how much you can then therefore afford to have to make monthly payments. They are structured generally as a LIBOR. So I don't know how familiar people are with that, but the LIBOR is an interest rate that's out there. It's the London International, forgetting the last 3 letters, but it's a stated interest rate. So it's usually LIBOR plus a percentage. So LIBOR plus 2.5, which would be, if LIBOR right now I think is at like 1.4. So LIBOR plus 2.5 would be 3.9% of the amount that you're borrowing. So it's fairly cheap money. And it is structured as a term loan, as I think I said before, so you make monthly payments on it over the life of the loan. It's fully amortizing generally, which means that you, like your mortgage, over however long the loan is, and it's generally 5 to 10 years, averaging about 7, you'll pay off the entire amount of that loan over that period by making monthly payments. So you'll pay both an interest and a principal payment every single month.
Great, thanks so much. I will move you on to the next slide now.
So this slide looks at kind of the primary forms of capital or of debt that most growing businesses or growing technology businesses in particular have access to out there, and kind of we go through a little bit of comparison of what to expect from all of these different items. So merchant cash advance was one that I talked about a little bit at the beginning. They require personal guarantees. So maybe I'll go down and then go across. So personal guarantees are required by merchant cash advance and banks generally. So some banks, once you get bigger, probably over the 5 million revenue mark, I know we keep saying that, but that's really a big hurdle for most banks in terms of when they'll take away the personal guarantees, are going to require that you personally sign up to pay off this loan. So from their perspective, they're actually going to go after you, the individual, before they're going to come after the company to repay the amount that you borrowed from them. Here at Lighter, we don't believe in personal guarantees. We believe in backing your business. So we don't take personal guarantees. It's not one of our items that we require. We also don't have any financial covenants, which are a very big aspect of how banks actually underwrite you. So when I was talking about the traditional commercial loan, they underwrite you based on your net income or the amount of earnings that you're receiving. They will have every single month a covenant that you have to meet that says how much of your net income you can be either negative or positive on a rolling basis. So looking back at the last 3 to 6 months. We don't use those at Lighter Capital either. We're betting on you, the entrepreneur in the business, and so we don't have financial covenants, so you wouldn't see those in our structures. Venture debt has, as David was mentioning, they require that there be a VC on the board. They will take board observation rights, so they're going to want to attend and listen to your board meetings, and they will also have some type of financial covenants that you have to meet on a monthly basis. So when we go into the next slide, we talk about different, when you're thinking about what works best for you, you need to think about, do I want financial covenants? Do I want to do a personal guarantee? Do I want, do I have a VC already involved in my business? How do I want to think about all of those things when I'm making a decision? And to be honest with you, the bank debt with the personal guarantees is going to be cheaper because of that, because they're betting on you to pay it off. It's also a big question when you're looking at debt financing is, what do you plan to use the funds for? So is this a working capital investment, or is this a growth investment, or if it's a case of merchant cash advance, is this an emergency that you just need to get that through that month? So the use of funds is pretty important when choosing a debt option, because debt can be expensive, and so you want to make sure that you're going to get your bang for your buck out of whatever you're actually borrowing. Obviously, the cost of capital can vary significantly depending on the type of loan that you take, as will the type of credit analysis that happens. So merchant cash advance is just going to look at your FICO score and make a decision from that. The bank is going to think about your FICO score and your business, and venture debt and revenue-based financing are going to take your business into consideration. So it's all based on your business. And then the terms are also, so how long will this be out there for? How long do you want to have the debt sitting there for? All of these are going to be key factors when we talk about kind of making a decision. Merchant cash advance is fairly short. It's less than 6 months. Banks, depending on the type that you get, the line of credit, they generally renew every year, so that's kind of a shorter term revolving mechanism, but the term loan structure is going to, your traditional term loan is going to be longer, 7 years on average. Revenue-based financing is longer. We do a 5-year term loan. Venture debt is also longer. They're probably around 7 years on average. And then the dilution. So David has, and I've talked a little bit about already, kind of the impact of equity and convertible notes and how those can be fairly dilutive. Some of these debt players are also going to take some type of equity, especially venture debt. They're certainly going to take equity as part of their payment. And then how the payment is going to actually be made. So merchant cash advance is a daily or weekly ACH out of your account. So they're just going to pull a set amount of money every single day or week. So that's something just to contemplate. The banks are going to have you pay them a fixed amount on a monthly basis. The revenue-based financing is fairly unique in this concept because it is paid monthly, but it is dependent on how much revenue you generate. So it is variable. There are very few forms of debt that are actually variable and from that perspective. And then venture debt is also fixed, so there's a certain amount that you're going to pay on a monthly basis. And then finally, kind of the last 2 points here are the timing and the speed that it takes to get this done. Merchant cash advance, I'm sure you all have heard it online. It takes them hours, 72 hours or 3 days to approve you. It can sometimes be even faster than that. I think there's one cabbage who talks about doing it in 7 minutes. It's all because it's all based on your FICO score. So they're just looking at, they're pulling your credit, your personal credit history and making a decision based on that. Banks, as we talked about at the beginning of the call, they take forever. They are a 4 to 6 to 8 month process. So you should get in there, get to know your banker now, because although they have the cheapest form of debt out there, in terms of the cost to you, hopefully, they are going to take the longest to get there. So it's good to get to know your banker now. Revenue-based financing, we do our loans in as quickly as 4 to 6 weeks. So it's a fairly fast turnaround. Venture debt is going to take 3 to 6 months, and they're going to be in line with the VCs. So they're going to be at the same time or shortly thereafter another VC, and they're going to piggyback off that VC has in order to do it.
Molly, can I just jump in on this point really quickly? Because I think that a lot of times we see our clients get incredibly mired down in the fundraising process. And if you are looking for a smaller amount of money and speed is of the essence, I think that the merchant cash advances and the revenue-based financing are a very good route to go, especially with the revenue-based financing. The process is really straightforward, and that's one of the reasons why we're such big proponents of it for our clients, is it's quick and it's easy and it's set terms so you know exactly what you're getting yourself into. And especially Lighter Capital does a really good job of expediting these as necessary.
Yeah, it's a good point. Speed is definitely, I mean, fundraising will take
It's important, right? Speed matters. So
it matters. And just from a distraction perspective, even from your business.
right.
So,
I mean, all of our clients are concentrating on growing their business and building their business, and the last thing they want to do is spend a lot of time doing fundraising.
exactly. Okay. So maybe we should talk a little bit about how to make that decision then, if you're out fundraising, and what you should be doing, what you should be thinking about, and kind of the key questions that you should be thinking about as you're doing that.
Sure. Look, would it be okay to we have a number of questions before we move on. First of all, just about revenue-based financing, Manny wants to know, can you explain a little bit more about how the repayments work with revenue-based financing?
Sure. So the repayments are a set percentage of net cash receipts on a monthly basis. So what happens is you get payments from your customers every month. At the end of that month, here at Lighter, we look at what your payments received were. You have agreed to a loan with us that's a certain percentage of your revenue, and that generally ranges from 2 to 8%, but let's just say 6%. And you pay, and so 6% of your net cash receipts for that month are paid out on the 15th. And so it's you know exactly upfront what it's going to be. You can think about it as an additional kind of cost of, you know exactly what the percentage is. So when you're doing your kind of COGS in your business, you know exactly what they are, and it fluctuates greatly. So if you don't make any revenue in a month, you make 0 payments to Lighter. You have a really big month, you're going to make bigger payments, but you have the cash coming in, so it should align very well with your cash flow dynamics.
Okay,
Which is a very nice point, Molly, and I think should probably be emphasized, is that it does vary as your returns, as your revenue increases, your payment increase, but it's very much in line, which is a nice way to structure it.
And there's a kind of a follow-on question from Frederico around this. You know, you mentioned COGS. So he's asking, what's the accounting and tax treatment of a revenue loan, and do you consider it as COGS? So just to reiterate your point.
Yeah, so actually it's not considered COGS because you're making interest. Each payment you make is partially interest and partly principal. So it would be treated the same way that you would treat any other debt finance line item. So it would go below your net income in your interest line, or go above your net income in your expenses as interest expense. And
can I just if I could just give a little plug for early growth at this point. If you are getting to a point where you're thinking about all these different debt options, but you're trying to figure out what the proper accounting for this is and how to record it accurately on your books and how to make sure that you're in line with generally accepted accounting principles and with IRS requirements, that's a great point in time to give early growth a call, because that's what we do. And we'd love to help any of you out with your accounting questions and take care of your books for you at a very low price. So if you give us a little plug there.
Yeah. Actually, asking that question is great, because that's a sign that he's trying to keep great records. And one of the best things, you know, talking to any of these here, banks, through venture, this merchant cash financial case, but you personally, they're going to want to see good financials, and having your financial house in order when you first present your financials to any of these debt providers makes you look as an entrepreneur so much more savvy than 95% of the people that they see. So going to early growth and getting them to get your books in order before you actually talk to any of these debt providers is going to bode very well for you in terms of the cost of your capital and the speed with which the financing gets done.
Okay, we still have a couple more questions, if you don't mind. Can we just stick with the questions for right now? Okay, just kind of piggybacking on what you were just talking about in terms of investor perceptions. Sophie wants to know, how do equity investors view these different forms of debt? Do any inhibit my ability to raise VC or angel investment?
That's a really good question, and no, I think the only one that might inhibit you a little bit is the merchant cash advances, because depending on the type you take, and if you have to continually roll them over, if you're not actually using them as emergency and paying them off, investors, angel investors, or other equity investors might think that you have a cash flow issue. But otherwise, most equity investors, especially as you get bigger and as businesses grow, want to put debt on businesses in order to leverage their own equity investment and get better returns. So all of these are seen fairly favorably by equity investors. David, you may have a different opinion on that, but that's generally what we've seen here.
No, I agree with that. I think you're totally right on, Molly. I think that's totally right.
Okay, and then just one more question before we move on here. John wants to know, can revenue-based loans negatively amortize?
No, but that's a good math question. No.
Can you break it down a little bit for people who may not follow the question?
So, so there's always whatever, even if you made a zero payment that month, it would just be a split of zero. So you wouldn't have, what he's asking is, could you have a principal increase instead of decrease every single month? And no, once you've made a principal, once the payment has gone towards principal and paid it down, you can't increase your principal without borrowing additional capital for that revenue-based line.
Okay, great. We have a few more questions, but why don't we keep going, and I'll hold them for now, and we'll get to them a little bit later.
Okay. We'll quickly run through kind of the key questions, because I think it's to ask yourself, because I think it's really good to also answer some questions that people have. But when you're making some decisions about what type of financing you want to do, it's really important that you understand what the long-term goals for your business are. So, because that's going to determine what type of financing you need. If you just need working capital for your business and you're not trying to grow to the next level, then kind of the venture debt and the revenue-based financing may not be great fits for you, and the line of credit from your bank is better. If you want to grow to the next level, you're going to maybe want to take a revenue-based financing or go a venture debt route or something along those lines that's going to give you a little bit extra oomph to get to the next point. Something David and I have talked a lot about here is how much control do you want to maintain of your business? Because certain types of debt and equity, or convertible debt, which is definitely more equity than debt, as David pointed out, are going to impact your equity ownership. So good to have some understanding of what type of control of your business you want to maintain. It's also really important.
Think about the equity equation. Don't just think about it at an early stage, whether it's debt or equity, but also think about the fact that once you start raising equity rounds, typically that means that there's going to be several subsequent rounds. So don't just think about your initial dilution with the initial equity deal, but once you start down that track, it's a very slippery slope. And what's going to happen is a series of progressively larger equity rounds where there's going to be more and more dilution. So you want to be very proactive on it. You want to put off the equity piece as long as you can and mitigate it as much as possible. So your equity in your company is your absolute most valuable asset, more valuable than any other asset that you have. So protect it with every initiative that you have. Anything that you can do to preserve your equity for as long as possible is a very good thing.
And I think that leads right into kind of the risk tolerance / appetite is kind of, do you want a short-term or long-term loan? Kind of goes into your risk tolerance, but also kind of what's your timeline for exiting your business? And so kind of what's your appetite for taking on additional debt? How much do you need? Kind of understanding all that. But I think the most important question to ask yourself on this page is, are you prepared for an outside investor? So are you ready for somebody else to come in, look at your books, look at how you set up your legal system, look at all of those key aspects of your business and make a judgment call about it? I think it's really important that you have, especially your books, your financials, in order before you talk to any debt provider or any equity provider. And I think David and Early Growth are a great option for lots of people who are out there, lots of growing businesses out there, to go and have somebody just take a quick look and see if there's some way that they can help you out to make sure that you're accounting for everything properly and you don't run into any issues when somebody else starts digging through everything.
And we get a large number of our clients at this stage, and oftentimes we'll actually get them from a venture capitalist or from a debt provider who's interested in a company, but they just aren't ready in terms of their internal accounting and their internal infrastructure to go out for that debt line or for that equity participation. So this is a great stage to reach out to us and just have a conversation and see if we can help you out.
Yeah. So then we have kind of the checklist, and obviously the first one that we've been hitting on is getting your financial house in order. So does your balance sheet balance? I think one of the first things we see here at Lighter Capital that jumps out to most people on the underwriting team is if the balance sheet doesn't balance. So it's good to understand what all the ins and outs are and why it should work out, why your numbers, understand your numbers, and so that you can answer basic questions about why did you account for something this way, or why did you put this number in this expense category? And that's definitely something that David could help you out with.
Yeah, no, absolutely. I mean, this is just, in a way, it's a perfect plug for early growth. So everything on this funding checklist is what we do with our clients and how we help them get ready. So
Yeah.
this is a key point. If you don't have a firm like Early Growth, make sure that you have someone, preferably someone who has CFO experience working with early stage companies, and someone who is either a CPA or very well versed in generally accepted accounting principles.
Yeah.
All that boring stuff you don't want to worry about.
Exactly. All the stuff you don't want to distract you from your day-to-day business.
Exactly right. Oh yeah, we'll take it all. We'll take it all.
If you haven't done it, you're not going to be able to get a loan. So you'll get a loan that's personally guaranteed, like an MCA, but you're not going to be able to get a bank loan. You're not going to be able to get a revenue-based financing loan. You're not going to be able to get a venture debt-backed loan. And you're not going to be able to get, a lot of some angels, but you're not going to be able to get any true venture capitalist into your firm without all these things in order. So your financials need to be in order. Your legal house needs to be in order. Are you in good standing is a good question, because all of the banks are going to run a good standing check on you. It doesn't cost that much to run a good standing check, and definitely worth doing to make sure your taxes are paid and your franchise tax is up to date, all of that type of stuff. Really helpful to have a business plan. It's not a requirement that it has to be super detailed in 5 years of projections, but some idea what you're planning to do in the next 2 years and how you plan to use that capital that you're about to borrow to do it is a good thing to have. Having a sales plan, so knowing who your key customers are, what channel you're planning to go out of, what your best approach is for getting them, and knowing your metrics. So whatever industry you're in, you really want to understand your metrics and be able to present them to your potential investor so that they can get comfortable with them, because they're certainly going to ask you all about your metrics.
I think that's great.
Yeah, so I think that really covers, the primary stuff that we wanted to cover on this debt funding call. Were there any other questions, Erica, that we should go to?
Yeah, we have a couple of questions, and sorry, folks, as you can see, I just skimmed past a couple of slides there. That will be in the deck that you can look at when we send it out to you tomorrow. It just has a little bit more information about Lighter Capital and how they work, but we won't go through that here in this presentation, but you'll have it for your reference. But we do have a couple more questions actually about revenue-based financing. So first, Larry wants to know, can revenue-based financing be revolving or at least draw out only what is needed over time? And then he specifically says he might want $1 million but draw it out over time. So he may need to follow up with you offline, but I thought the question about whether or not it's revolving might be useful for the full audience.
So that's a really good question, Larry, and it's actually something we talk to a lot of our borrowers about. We recommend only taking what you need. Here at Lighter, we have a unique strategy. So we believe that you should only take what you need at that moment in time and then come back to us. Our underwriting process is very quick. It takes us 4 to 6 weeks to underwrite the initial loan, and then each add-on loan that we do takes a week. So definitely follow back up with me, Larry, and I can talk to you around how we get to $1 million and how we would do that over time. Revenue financing generally is not revolver-based. It is a term loan type structure. If you wanted something more revolver-based and you had a bigger business, an MRR line might be something worth looking at. But because revenue-based financing is generally structured for growth, it's not well suited for revolver-based financing.
Okay, great. Thank you. And then another question here from Natasha. She wants to know, if repayments fluctuate with your revenue, does that affect the term of the loan? And what happens if you pay it off earlier?
So that's a great question from Natasha. If you pay it off earlier, the loan is done. So the moment that you hit that final payment, so if you grow faster than we initially underwrite you to, the loan is done at that once we've gotten the full cap back.
Okay, and then I'm not sure I understand this question, but hopefully you will. Tracy wants to know, she says, I'm worried about the association of revenue-based financing with royalties. Is that association justified? My shareholders do not want royalties.
So revenue-based financing came out of the concept of royalties. But it's not structured like a royalty. Like your traditional royalty would be for the pharmaceutical industry, where somebody got a percentage of a pharma sale that was out there. So Tylenol, they were taking a percentage every single month off of Tylenol until they were paid back a certain amount of money. That's how revenue-based financing was originally thought of. but we do it based on net cash receipts, so it's not tied to any one particular product, it's tied to your overall business. So it's a little bit different than royalties, but certainly the original idea behind it came from royalties.
Okay, thanks.
I would say on that, I'd say that the perception nowadays is very different about revenue-based financing versus royalties. I think that in the early days there was probably some confusion and some overlap. I think at this point in time they're really considered two very distinct, different mechanisms. And if your investors are having a hard time with revenue-based financing and they see the royalties, probably what you need to do is just have a clarification conversation, because you're probably fine once they understand the distinctions.
Yeah.
And I apologize, that question was from Frederica. This question's from Tracy here. Tracy wants to know, what's the average term of the loans for Lighter Capital?
So Lighter Capital's loans are structured to be 5-year term loans.
Okay. that was fast. Yeah. I was ready for a longer answer. Okay. And we have a question here. Is the full amount of interest due if the loan is paid off early, assuming the loan goes full term?
Well, the loan wouldn't be paid off early if it went full term. But yes, the way revenue-based loans are structured is you pay a certain amount. You know exactly what you're going to pay up front. So you're going to pay 1.7 to 2.3x the initial principal amount. So as an example, if I lent $100,000 and it was a 2x cap and it was $200,000, so you'd owe $200,000 over the 5-year period. And so the minute you pay the $200,000, the loan is done and there are no more payments that you need to make. But you will pay all principal and interest until you hit that $200,000 mark.
Okay, sorry, they're just rolling in here. I'm trying to keep up with them. Okay, Christopher wants to know, if you receive a revenue-based loan from Lighter Capital or an organization like yours, what ongoing role would Lighter play in the company, if any? For example, would you attend regular meetings? Would there be reporting needs? Would you have a board seat? Any other obligations?
That's a great question, Christopher. We at Lighter Capital consider ourselves VC light. So we would not have a board seat. We would not attend regular meetings, but we would help you if you needed help. So we would, if you're having financial difficulties organizing your books, we'd introduce you to Early Growth Financial. If you were needed help with a lawyer, we'd help you find a lawyer. One thing I did last week is I was helping somebody interview CFO candidates. He was actually trying to hire somebody for that position, and so he wanted to hire somebody full-time, and we were helping him interview people for that. Last week I was also helping somebody because he had a question about a sales presentation that he was giving. So I sat and listened to a sales presentation and gave feedback on how to improve that. So we will do as much or as little as you want. So we will not sit on your board and because we don't take equity, we don't sit on your board. We're not going to be dilutive in that way, but we do have great contacts out there, just like David does. And so we like to be as helpful as we can be and using our contacts to help our borrowers as best we can.
Great, thanks so much. I think that is it for questions for right now. For folks who still have outstanding questions, you can see the contact information here. So feel free to reach out to Molly or David to follow up on anything they said, or if you have any additional questions. And just
by the way,
yeah.
Great questions. I
know.
Sorry to cut you off, Erica.
No, I agree.
I love the participation. So thank you all so much. Great questions.
Yeah,
It's interesting for us.
Exactly, and it's nice to know people are listening.
Yeah, definitely.
So that's great. Yeah. So just a quick plug for us. Our next webinar is scheduled for June 9th, and it's a convertible notes Q&A. As David mentioned, we did a webinar recently on how convertible notes work, and there was such a great response to that, a lot of questions around it. So we decided to just have a Q&A, and it's with Kevin Smith from Seed Change and Gadiel Morantes with Early Growth Financial Services. So if you're interested in learning more about that particular webinar or any of our other upcoming webinars or other events, you could just go to our website and check out our events page and get more information and register right from there. So thank you, Molly and David, so much. I think this was incredibly useful, and I hope the audience, was able to get a lot out of it. And we really appreciate your time and the time of everyone who sat with us for this hour. So thank you.
Thank you, Erica, and thank you, Molly. I thought this was great.
Yeah. Thank you, Eric. Thank you, David. It was great.
Of course. Okay, take care. Okay, bye-bye.